Welcome to Blueprint for Wealth, and today with me is my special guest, Mimi Duff. Welcome, Mimi.
Hi, welcome. Thank you for having me today.
It's great to have you. I'm going to give you a little bit of background on Mimi, and then we'll jump right into it. And by the way, we're going to try to cover a few topics today. The takeaways are, what's it like being a woman in the financial services industry back when she started and and today? Number two, what are the challenges that clients are facing in the financial services industry today, and how is GenTrust dealing with it? And then number three, Mimi's going to tell us a little bit more about GenTrust's unique way of servicing their clients. She's a senior client advisor at GenTrust and part of the advisory team. She develops and serves institutions, high net worth individuals, and really cultivates family relationships. But she started her career in financial services years ago in the banking and finance industry, starting at Goldman Sachs in fixed income portfolio management, trading, research, and strategy. She moved on to Barclays and then to Tudor Investment Corp as the fixed income portfolio manager and strategist within their funds flow research. She graduated from Cornell University, a great school, in operations research and industrial engineering. And she's a frequent contributor to CNBC and Bloomberg. I've seen her on CNBC and she's fabulous. She really responds to the questions really fast and articulately. And she lives in Greenwich, Connecticut with her husband and 4 daughters. Yikes. But it's great to have you on board. And the first thing I wanted to touch on was, what was it like coming into financial services when you came into the industry? And what's it like today as a woman? What are the challenges that you faced and that you face today?
Yeah, so I would say, well, first of all, I graduated in 93, so I'll age myself.
You don't have to tell us.
I just gifted myself almost 30 years experience. So I'm just going to frame the conversation that way. But,
okay.
And I studied engineering, which primarily back then was really, really heavy men. So I got a bit of training for the heavy men industry when I was in college, frankly. And coming into Goldman in 1993, I would say the training program was more 50-50, women and men. So that was great. Now at the higher levels, then, and as it is now also, there's just a stark, it's a stark difference. And there are very, very few very senior women in the investment banks. That I think happens for many, many reasons, including families, choices. In many cases, a spouse is traveling all the time, maybe has also really challenging, demanding career. So yes. There's a lot of factors there. What I would say is that for young women, we're missing role models in some of those big institutions. At GenTrust, I'm working now with some of my former colleagues, which is so excellent. It was a big driver for me to come here. And I was commenting with some of my colleagues today, we're more 50-50, but broadly, I think the institutions are still skewed toward more men, especially at the higher levels.
How can that change? What would you do to change the industry to make it more equitable, gender-wise?
Well, I really hope, I like to think that we can take the silver linings from COVID. And I think COVID has provided men and women a great deal more flexibility. And I'll just be perfectly honest here. I'm a little saddened that it took the guys coaching the football team or the soccer team at home to say, hang on a second, this does work, this flexibility here and there. But I do think that companies are granting a greater degree of flexibility. When I had my 4 daughters in a span of 5 years, those were really, really hard years. When I was waking up at 4:45 in the morning and getting to work between 6:30 and 7, they were hard years to have little kids. So I think a bit of flexibility goes a long way. More women at the top will also help a lot, because as it is now, these very few women at the top don't feel like they have more than enough political capital to help other women.
It's funny. I think about it. I have a good friend out on the West Coast who runs an RIA, a registered investment advisory firm, and she started it in 1990 from scratch, and recently sold it to a family office, which is also run by a woman. So I think they're sort of they're trendsetters, if you will. And I also think of Kathy Wood at ARC. She's set up a bunch of mutual funds, and she's the CEO of those funds. And more women are rising to the top like you, and I congratulate you for your success. So, what's the challenge that we're all facing? I mean, we see that the Fed is increasing interest rates. They just increased rates again. The market is acting very squirrely. It's very volatile. How are you handling this with your clients, and what's GenTrust's strategy to placate the nervousness and anxiety that's going on?
So first, let me just frame the conversation a bit in terms of where the Fed's at. The Fed funds rate right now, yesterday, the Fed hiked again. We're at 3.25. And importantly, when they surveyed Fed officials in the meeting, they felt that this year end, the funds rate would be at 4.3%, and next year end, 2023, 4.6%. These are much higher than was anticipated, say, a year ago.
Okay.
Just also to put it in perspective, the unemployment rate is at a 50-year low at 3.5%, and inflation is at a 40 some odd high. So the Fed is doing this, raising rates to help slow the economy and bring that inflation in line so that they can achieve longer term price stability. Their target for inflation is 2%. The U.S. Fed Central Bank has a two-mandate approach. They're targeting both employment and inflation. Most central banks only target inflation. So what we're seeing is around the globe, central banks raise. Sweden raised 100 basis points the other day. Switzerland 75 today. Yesterday was at the Bank of England 50. It's a global move. So how are we handling that for our investors?
And this is also, by the way, as we're recording this, we're at the end of September. When it finally gets broadcast, it'll probably be towards November, December. So put yourself in November, December. But yeah, how are you dealing with that today?
Yeah, so we really forecasted these higher rates a year ago, or even prior to that. We thought rates were too low. The economy was booming. And we really felt like, why is the Fed still easing? Which they were in fall of 2021. They were still buying securities every day. And we recognize the Fed has to stop easing before they can start tightening economic conditions. So at that time, we were underweight equities. We were underweight fixed income. We were overweight real assets, which have a greater amount of exposure to commodities and inflationary pressures. So that was our positioning coming into 2022. Now, that enabled us to really square up in June when equities were at the time low. They had pulled back about 20%. And just for perspective, we tend to have these 20% drawdowns every 3 to 5 years. That's kind of part of life when you're looking at the long-term history of stock markets. Bigger declines of, say, 30 to 50% tend to happen more every 10 years, and they are also tend to be accompanied by something much more dramatic, like the financial crisis. We can all kind of recall that incident where the stock market was down more than 50%. Or the pandemic, frankly. We were headed in that direction before you saw a massive global response from the central bank community.
Or Russia's threat of nuclear war.
Yeah, like these bigger...
Which scares everybody.
It sure does. And especially if that were to escalate more, I think you'd really see risk assets take it on the chin even more. Okay. So for context, coming in, we were underweight equities. We were able to square up. We squared up a bit more on the fixed income side. We felt like, and we continue to feel this way, for long-term, long-only investors, which is what we are, these entry points are so much more exciting than a year ago. A year ago, you had S&P, like the equity market, PE valuations were really stretched. You had yields really low. It just, when you thought about like, well, what's my chance of making a decent amount of money or a decent amount of return over the next 10 to 20 to 30 years, we're much better positioned now. So as of right now, we're fairly neutral across the board. We have been rebalancing portfolios. By that, I mean, as equities drop, we'll buy more equities to hold the appropriate weight in the portfolio. But we're looking closely at levels to see where we might add exposure, because we do think that these are pretty significant drops here.
Are alternative investments a high risk in this environment, given the inflationary pressures that we're experiencing?
Yeah, so alternatives, the key driver there is you have a massive lack of liquidity, right? So you really want to be compensated for that lack of liquidity. And we at GenTrust have an alternatives arm, and we do a good deal of due diligence on anything that we would recommend to clients or put on our platform with that filter in mind. Are the returns going to compensate you above and beyond the lack of liquidity that you're likely to suffer through?
That's a good analysis. So it's evaluating the risk and lack of liquidity versus what you're willing to tolerate over the period of time that you're going to be investing. So that's an interesting approach. Does that satisfy your investors? Are they okay with that approach? Are they comfortable? Are you making them comfortable under the circumstances?
I think our investors are comfortable with their
Good.
portfolios. I think that they look. We've heard from other outside folks, or people will come to us and say, "I don't know what's going on in my portfolio. I'm down this much." And if we take a closer look, we see potentially heavy tech concentration, which last summer, last fall,
Very risky.
it's not only risky because it's more volatile, it's also really exposed to higher rates. And we spent a lot of time making sure that our clients didn't have over concentrations to tech. Now, many of our clients work in the tech industry, and they do have some exposure there, right?
Sure.
But we were very, very aware of the risks to higher rates, say, that tech takes on. With respect to the alternatives, we do think there is a there's a purpose for alternatives. In some cases, they can be tax advantaged. Obviously, most of our clients are after tax investors. Some of the smaller institutions potentially don't have the same tax impact, but that we look at it through a lens of liquidity, returns, taxation. All of those things come into play.
So getting to the third thing that I wanted to focus on is, tell us about GenTrust's platform. What is it that makes GenTrust unique as compared to other registered investment advisory firms?
Yeah, so just a bit more background about RIAs. We're a multifamily office, we're fiduciary, and all the RIAs are fiduciaries, meaning we don't get paid to sell stuff, right? We're on the same side of the table as our clients, and we get paid advisory fees for that.
Right.
What sets us apart is we primarily lead with the investment side, and our investment team has more than 150 years experience on the institutional side of trading desks. By that, I mean servicing pensions, insurance companies, managing risk at hedge funds, not on the private wealth arm of the banks where some portion of the compensation of those advisors is coming from selling stuff for the most part. So we are fiduciaries. We have a lot of experience in risk management, and this 150 years experience on the institutional side, I think, really sets us apart. The other bits is we're very transparent. So our clients will know when we are right and when we are wrong, because we offer a snapshot whenever they want of their performance versus a benchmark, which is how the entire institutional world thinks about finance. The pensions of the world, the insurance companies, they have a benchmark, meaning they're tracking their returns versus a bond index and an equity index, a commodities index. We do that same thing for our clients, and we have a very humble goal of beating our index after our fees. and providing these other services like financial planning, like making sure that our clients are well covered on the estate and as the estate side, on the accounting side, the stuff that your firm and others can provide. For the most part, we stay in our lane. We focus on the investment side of the equation, and we think we do a good job at that. But we are, I would say, the transparency sets us apart. And finally, the way we look at risk, because we are kind of in our hearts risk managers, we tend to we look at potential risk outcomes and we can stress test portfolios against them. And this, again, is very much like a hedge fund thing, an institutional asset manager type thing. Hey, what types of bad things can happen in the future world? Could there be this kind of crisis, that kind of, and how would my portfolio perform under that circumstance? So that's also a big differentiator for us. We lead with that risk management side too.
What's the typical client at GenTrust? What do they look like?
Hard to say. It's hard to say. It could be, I'll give you some examples. It could be an entrepreneur who is coming up against a liquidity event. We would want to make sure that they were well covered well ahead of that liquidity event on both the financial planning, also the estate planning, the tax planning. These are complicated matters. That could be one situation. Another situation, multi-generational family wealth would be another situation. A business sale. We actually have a lot of financial professionals as clients. Folks that just, they know us, they recognize what we can bring to the table. I like to say to those folks that, like, we're doing what you would do if you were doing this full time.
Right.
So, and many financial professionals have restrictions on when they can trade their personal accounts and what the holding periods are. So for them, it really makes sense to have a managed account. There are other situations where you just have very wealthy clients and, they trust us to know what they don't know for whatever reason. Most money is made in a very narrow way, whether you've made a special widget and you've sold it, and then you keep your wealth in a very diversified way.
What would you say the biggest challenges RIAs are facing today and into the future?
Well, one of the things I think is brand recognition, because the RIA side, there's just so many RIAs, right? Like the JP Morgan Wealths of the world, like, oh, I've heard of them, or they can see when you deposit $2 million into your bank account, they're calling you. Right? They're seeing the dollar signs and they're making the outgoing call. So I would say there's a bit more onus on the potential clients to say, hang on a second, do I want that guy who's going to sell me something, or should I spend a bit more time trying to figure out what this landscape's all about? That's one challenge. On the flip side of that, everybody that I really know and respect that has been on that bank-based non-fiduciary side has moved in the direction of fiduciary. So I do think there's a massive shift in the direction of fiduciary. So that, I think, is giving us tailwinds.
So when you say bank-based, you're referring to the Bank of America, Merrill Lynch's, the Morgan Stanleys, the JP Morgans, the Goldman Sachs's of the world versus the RIAs that truly don't sell product that's associated with the bank, either loans or whatever it is that they're doing. On the devil's advocate, would say, well, they also offer, bank services that you can't offer. How do you compete with that?
Yeah, that's absolutely right. We're not a bank. But the flip side of that is we have relationships at all the banks. So nobody negotiates a mortgage better than I do. I've been a rates person my whole life. And I know a good rate when I see one. So yeah, like we stay in our lane. We're not lenders. We have relationships at many big banks, and we can help clients.
But you help your clients find the best
Absolutely.
source of funds. So,
Absolutely.
well, that's great. This has been great. Again, as a successful woman in the financial services industry, I congratulate you and having overcome a lot of the challenges that you probably faced and many of your compatriots faced 30 years ago. It's still a glass ceiling in many ways. We've got to overcome that as a society. That's my own 2 cents on it, but I congratulate you on that. And I also congratulate you on a highly successful career at GenTrust. And thanks for being a special guest on Blueprint for Wealth.